The March 2026 inflation report just dropped, and the numbers are telling a story that every American needs to hear. Prices are still going up. Not as fast as they were a couple of years ago, but they are still climbing, and the details buried inside this report reveal exactly why your grocery runs feel more expensive and why buying a home still feels out of reach for so many people. Let's break this all down in plain English. First, the headline number. The Consumer Price Index, which is the government's main tool for measuring inflation, came in at 330.293 for March 2026. Now that number by itself doesn't mean much unless you compare it to where we were. Back in April 2025, CPI was sitting at 320.302. That means over roughly 11 months, the index climbed about 10 full points. To put that in everyday terms, something that cost you $100 in the spring of 2025 now costs you somewhere around 3% more. That adds up fast when you're talking about groceries, gas, rent, and everything else you buy regularly. Now here's where it gets more interesting. Economists and the Federal Reserve pay very close attention to something called core inflation. Core inflation strips out food and energy prices because those tend to swing wildly based on things like weather and global oil markets. The idea is that core inflation gives you a cleaner picture of where prices are actually trending. And core inflation, measured by the CPI less Food and Energy Index, came in at 334.165 in March. Compare that to 326.467 in April 2025, and you're looking at a similar upward trend. Core inflation is sticky. It's not dropping fast, and that matters enormously for what the Federal Reserve decides to do next. So what is the Fed actually doing? The federal funds rate, which is the interest rate the Fed sets and that ripples through the entire economy, has been sitting at 3.64% since January 2026. That's actually down from where it was. Back in the summer of 2025, the rate was holding at 4.33%. The Fed has been slowly cutting rates as inflation showed signs of cooling. But with core inflation still stubbornly elevated, the Fed is in a tough spot. Cut rates too fast and you risk letting inflation roar back. Keep rates too high for too long and you risk slowing the economy down more than necessary. Right now, the Fed appears to be in a holding pattern, watching and waiting to see if these inflation numbers continue to ease or start ticking back up. And then there's the housing market, which is where a lot of Americans feel the pain most directly. The 30-year fixed mortgage rate was sitting at 6.3% as of April 30, 2026. Earlier in the year, rates had dipped as low as 5.98% in late February, which gave some homebuyers a brief window of hope. But rates climbed back up through March and April, reaching as high as 6.46% in early April before settling back to 6.3%. For context, if you're buying a $400,000 home with a 20% down payment, a 6.3% rate means you're paying roughly $1,980 a month just in principal and interest. That's a significant burden, and it's one of the main reasons the housing market remains frozen for so many first-time buyers. So what does all of this mean for you personally? A few things. Your cost of living is still rising, just more slowly than the peak inflation years. The Fed is not in a rush to cut rates dramatically, so borrowing money, whether for a car, a home, or a business, remains expensive. And while some relief has come, the full return to the low inflation, low rate environment many people remember from before 2021 is not on the immediate horizon. The smart move right now is to stay informed, keep a close eye on your budget, and if you're considering a major financial decision like buying a home or refinancing, understand the rate environment you're stepping into. Inflation may be cooling at the edges, but it is not gone. And the Fed's cautious approach tells you everything you need to know about how seriously they're still taking this fight. We'll keep watching these numbers every single month and breaking them down for you right here. Make sure you're subscribed so you don't miss the next report.